Atul Singh, CEO and Director of LGT Wealth, joins us now to discuss market fundamentals as well as its top sectoral picks. Thank you so much, Mr. Singh, for joining us. First up, post this very sharp correction we saw, Indian markets have actually rebounded quite significantly. Do you feel that this particular rally can sustain, or do you feel markets once again could revert to fundamentals where earnings has been quite muted?
Thanks, Vivek. Thanks for having me on the show. No, I feel that the rally has more steam, and it's sustainable because it's driven by, of course, locally RBI started the rate cut cycle. The inflation came in within the 4% plus minus 2% range. So opening up room for 2 more rate cuts, possibly later in the year. Tax cuts from the budget will help consumers as well in terms of their discretionary spending. Valuations have come down also to reasonable levels. So, the market is trading at, on a 1-year forward basis, 1 standard deviation lower than the long-term average, so reasonable valuations. And above all, globally also, the yields have cooled off in the US, as well as the dollar has gone down a little bit and cooled down. So I think combining the global situation as well as the fundamental factors in India, we feel that the rally is sustainable and has legs to go.
You believe it's a great time to build an investment portfolio, Atul. Morning, Rima here. So how does one go about building a great investment portfolio now for the next 3 to 5 years?
Well, I mean, you're right. I think because of the valuations now being reasonable, if you enter at this levels, you are going to get earnings growth and slightly more than earnings growth because the market is slightly lower than the long-term average. So an earnings growth expected to be healthy. So what I would advise investors is to start building the portfolio, pick the right sectors. You will always see that the next leg of growth comes from sectors or leaders that were not there before, and there is a bit of rotation. So keep an eye, think about what the fundamentals are, and start building the positions in the right sectors and the right companies.
So, Mr. Singh, which are the right sectors that at this point of time you are looking at entering or further increasing your positions, and which are the sectors that you're looking to avoid?
I think banks, both, so financials, both on the bank and the NBFC side, look quite attractive. Consumer discretionary, because of the tax cuts, are sectors well poised. I think to some part defense, because of this whole pressure in Europe to really build defense capabilities, a lot of suppliers that will get benefited from India. So some of those sectors are attractive. I think IT looks attractive as well. A lot of IT companies, their subsidiaries will get benefited with the rate cuts that will happen in the US. And generally, the IT spending is at its high in the US. So IT companies are beneficiaries of that. In terms of the sectors to avoid, I would say consumer staples is probably one sector I would avoid. But great opportunities now emerging.
What about these quick commerce kind of plays? Zomato, Swiggy, they were the favored sectors, the best play on premium discretionary consumption, but they seem to have fallen out of flavor a tad bit. Where do you all stand on it?
Well, I think, the sector is evolving. The competition is increasing. So, obviously, it's a great use case to digitize and there is massive scale that can be generated. But in the end, it's a game of execution. Whoever can execute, it's not about technology. It's about really operational excellence. And with the increased competition, the jury is yet out who will actually win the game. Because of scale being paramount here, it is sort of winner-take-all market. So that's why there is risk, because it's not going to be 4 or 5 companies that will get a lot of capital and build a lot of scale. So it will be 1 or 2 companies, but with the increased competition, it's yet to be seen who could be the player. And that's why there is uncertainty in the market, because just the competition has gone up quite dramatically.
What is your view as far as the entire pharma pack is concerned? Stocks, especially in this particular space, have been very, very volatile. Worries about impending tariffs. Do you have a view on what exactly could be the final rate of tariffs? And whether Indian companies from here on can outperform?
We feel that I think across the board tariff in the US on healthcare pharma companies is difficult to be applied because US needs to reduce its healthcare cost. So, but even if that gets applied, the Indian companies are relatively better positioned because in generic, the profit margins are very thin. So we feel that they will be able to pass on a lot of the increase in tariff or increased cost to the users. And also there is very limited generic drug manufacturing in the US for USA to really sort of compete against. So we feel that the impact of tariff, if at all there is, will still be limited on the pharma. And that's what we feel. Sorry, just
Mr. Singh,
sort of
yeah. No, we got that. So we got your views on pharma out of the way. So what we are looking at is capital goods as well as defense. Capital goods, again, stocks have corrected here. There have been worries about capex not picking up as expected. And, defense stocks, a few of them have corrected quite significantly from the recent highs. Any views, any positions over here?
Well, like I mentioned, I think there is definitely this play, of long Europe and Europe spending more on defense. So any company that is a direct beneficiary or a supplier, and there are in the defense pack, there are a few. So some of those will be a direct beneficiary and could be a good play to take.
Understood that. And lastly, BFSI, you did say at this point of time you do like this particular space. Within the BFSI segment, where does your preference lie? Do you like the banks? Do you like the NBFCs? Or any of the beaten down MFIs?
Not MFIs, but banks and high quality NBFCs. I think the credit growth in India is going to be higher than in the past, and RBI is also supportive of that. So banks and they are also trading at reasonable valuations, and also high quality NBFCs. I would still stay away from the beaten down MFIs because there the balance sheets of the users are fairly stressed. But banks and NBFCs both look quite attractive.
Okay. Thank you so much for joining us, giving us a view on various sectors and which are the sectors that could do well or some of the sectors to avoid from here on. But moving on, it's now time for a short break. We'll get you more on the markets on the other side.